Mortgage interest on first loan is deductible. Interest is on mortgages up to $1 million. Mortgage interest on first loan, deductible. Interest on mortgages up to $1 million. Interest on home equity line of credit is deductible. It's interest on home equity lines up to $100,000. Interest on home equity lines up to $100,000 deductible is interest on home equity line of credit. Adjusted gross income is gross income less adjustments. Adjusted gross income is gross income minus adjustments. Taxable income is adjusted gross income minus your standard deductions or itemized deductions minus exemptions. Taxable income. To find your taxable income, take your adjusted gross income minus any deductions minus exemptions equals your taxable income. A 1040 EZ uses a standard deduction. 1040 EZ, standard deduction. Who is required to file a tax return? Anyone that has income equal to or greater than the personal exemption, the regular standard deduction, and additional standard. Who has to file a tax return? Anyone who has income equal to or greater than the personal exemption, the regular standard deduction, additional standard. The due date extension is October 15th. The due date extension is October 15th. A due date extension form is Form 4868. Due date extension form, Form 4868. What is the best filing status? Married filing joint. Married filing joint is the best filing status. What is the worst filing status? Single. Single is the worst filing status. Different types of filing status. You have married, single, married filing joint, married filing separate, head of household, qualifying widow with dependent child. Types of filing status. Single, married filing joint, married filing separately, head of household, qualifying widow with dependent child. Separate property state. Married filing separately. Each separately reports their income, exemptions, etc. If you're married filing separately, each spouse will separately report their income, exemptions, etc. And this is a separate property state. Separate property state. Married filing separately. A community property state. Married filing separately. Most income is split 50-50. On a community property state, married filing separately, but most income is split 50-50. Qualifying widow with dependent child. For 2 years after the spouse's death, they can use a joint tax return. They must pay over half of the cost of maintaining their household where the dependent lives, qualifying widow with dependent child. For 2 years after the spouse's death, you can use a joint tax return. They must pay over half of the cost of maintaining the household where the dependent lives. Head of household status is an individual that is not married or has lived apart for the last 6 months. They are not a qualifying widow, they are not a non-resident alien, and more than half of their year. Head of household status, they are not married or they have lived apart for the last 6 months, not a qualifying widow, and not a non-resident alien. A qualifying person, you can have a qualifying child, dependent parent, or dependent relatives. Qualifying person, dependent parent, dependent relatives, qualifying child. A dependent parent is not required to live with the taxpayer. The taxpayer maintains their parent's home for the whole year and over half of the cost of upkeep. So a dependent parent is where the child, the taxpayer, maintains their parent's home for the whole year. They pay for over half of the upkeep in the home, and they are not required to live with the taxpayer. A dependent relative must live with the taxpayer. So if it's a dependent relative, they have to live with the taxpayer. It can be cousins, foster parents, unrelated dependents do not count. They must live with the taxpayer. A personal exemption phase out is 2% for every $2,500. Personal exemption phase out is 2% for every $2,500. The dependency exemption is for a qualifying child and a qualifying relative. The dependency exemption is for a qualifying child and a qualifying relative. Dependency exemption qualifying child, think of CARE, C-A-R-E, dependency exemption qualifying child, CARE, C-A-R-E. Close relative, there's an age limit. They must be 29 or 24 if a full-time student. Age limit, they must be 19. Or 24 if a full-time student. Residency, they must live in the same residence for more than half of the year and eliminate their gross income test. Dependency exemption for a qualifying child must be a close relative. The age limit is 19 or 24 if they're a full-time student. Residency, they must live in the same residence for more than half a year. And eliminate gross income test. Dependency exemption qualifying relative. Think support. Dependency exemption qualifying relative. There must be support over 50%, under taxable income exemption amount. Taxable income should be less than the exemption amount. precludes dependent filing a joint tax return, and only citizens. Dependency exemption for a qualifying relative, support over 50%, they're under the exemption amount, so their taxable income is under the exemption amount. It precludes dependent filing a joint tax return, and only citizens. Qualifying child for exemption, age limit. Qualifying child for exemption, age limit. Must be younger than the taxpayer. They must be below 19 or below 24 if a full-time student. Qualifying child for exemption, age limit. Younger than the taxpayer. Must be under 19, or if they are a full-time student, they must be under 24. Qualifying relative non-taxable income. Qualifying relative non-taxable income. You have Social Security, tax-exempt interest income, tax-exempt scholarships, and they don't count for anything for the under taxable income test. Qualifying relative non-taxable income is Social Security, tax-exempt interest income, tax-exempt scholarships. They do not count for the under taxable income test. A gain is taxable. It needs to be realized and recognized. A gain is taxable, needs to be realized and recognized. COD, canceled debt is included in gross income. COD, canceled debt is included in gross income. Because when your debt is canceled, you're basically being given that money as a gift. Even though you didn't physically receive it, your debt was paid off. Therefore, that is income to you. Therefore, when you have canceled debt, you include it in your gross income. COD, cancellation of debt. Guaranteed payments to partner are included in gross income and are subject to self-employment tax. Guaranteed payments to partner are included in gross income and subject to self-employment tax. Taxable fringe benefits are included in gross income. Taxable fringe benefits are included in gross income. Portion of life insurance premium. Premiums above the first $50,000 of coverage paid by your employer are taxable to the employee, and they are included in gross income. Premiums above the first $50,000 of coverage paid by the employer are taxable to the employee. They are included in gross income. Non-taxable fringe benefits. You have life insurance proceeds. Interest from deferred payout is taxable. And employer-paid accident, medical, and health insurance payments are non-taxable. Non-taxable fringe benefits. Life insurance proceeds, interest from deferred payout is taxable. Life insurance proceeds, the interest from the deferred payout is taxable. Employer-paid accident, medical, and health insurance payments are not taxable. Flexible spending arrangements allow employees to receive a pre-tax reimbursement of certain expenses. They can use them for qualified health care, and or qualified dependent care cost. Flexible spending arrangements allow employees to receive a pre-tax reimbursement of certain expenses, and they can use them for qualified health care and or qualified dependent care cost. Interest from federal bonds are taxable. Interest from federal bonds are taxable. Interest paid by the government for a late tax refund is taxable. Interest paid by the government for late tax refund is taxable. A gift received to open a bank account is taxable. Gift received to open a bank account. So the bank says, hey, we'll put $100 in your account if you open an account with us today. Well, that is taxable. Tax-exempt interest income. You have state and local government bonds, bonds of a U.S. possession like Guam, Puerto Rico, Series EE, and Veterans Administration insurance interest. Tax-exempt interest income, state and local government bonds, bonds of a U.S. possession, Series EE, and Veterans Administration insurance interest. Series EE is tax exempt when it's used to pay for higher education, the taxpayer is over 24, and they are married filing a joint return. Series EE is tax exempt when it's used to pay for higher education, the taxpayer is over 24, and they're married filing a joint return. Qualified dividends need to be held for more than 60 days during a 120-day period. The tax rate is 15% for most taxpayers and 0% for low-income taxpayers. Qualified dividends need to be held for more than 60 days during a 120-day period. The tax rate is 15% for most taxpayers and 0% for low-income taxpayers. Dividends that are return of capital are tax-free and when the company has no earnings and profits. Dividends that are return of capital are tax-free when the company has no earnings and profits. Life insurance dividend is tax-free. Life insurance dividend is tax-free. The form reporting interest dividends is Schedule B. The form that reports interest and dividends is Schedule B. Itemized tax last year refunded is taxable. Itemized tax last year refunded is taxable. Alimony is legally required. It can be cash or equivalent, credit card bills, college fees. It cannot extend beyond the death of a payee. Alimony is legally required. It's cash or equivalent, so credit card bills, college fees. It cannot extend beyond the death of a payee. Child support is non-taxable and non-deductible. Child support, non-taxable, non-deductible. Divorce property settlement is non-taxable, non-deductible. Divorce property settlement, non-taxable, non-deductible. Business income or loss, the form is Schedule C, CEZ. For business income or loss, use Schedule C or CEZ. Farm income uses Schedule F. Schedule F, farm income. The GL on disposition of property, gain or loss on disposition of property, use Schedule D and take the amount realized minus the adjusted basis. The gain or loss on the disposition of property is the amount realized minus the adjusted basis. Use Schedule D. Non-deductible IRAs, you have a Roth IRA and a traditional non-deductible IRA. Non-deductible IRAs, a Roth IRA, which has tax-free benefits, and a non-deductible IRA, a traditional non-deductible IRA, is partially taxable. IRA penalty tax exceptions, think Heimed. IRA penalty tax exemptions. Home buyer, first time, they get a $10,000 max. Insurance, medical expenses are more than 10% of their adjusted gross income. There's disability and education. The IRA penalty tax exceptions. Home buyers first time, $10,000 max. Insurance, medical expenses are greater than 10% of their adjusted gross income. Disability and education. Schedule E, rental income. Rental income goes on Schedule E. Form 1040 is used for a tax return. Form 1040, tax return. Unemployment compensation is included in gross income. Unemployment compensation include in gross income. It's income received, it goes in gross income. Social Security income, for low-income people, it is not taxable. Social Security income is not taxable for low-income people. For lower middle income, it's then less than 50% is taxable. For lower middle income, Social Security less than 50% is taxable. For middle income people, 50% of it is taxable. For middle income, 50% of Social Security is taxable. And for upper middle income, 50 to 85% of Social Security is taxable. For upper middle income people, 50 to 85% of Social Security is taxable. Provisional income, modified adjusted gross income. Provisional income, modified adjusted gross income. A prize is non-taxable when the winner selected without entering a contest and donates the prize to charity. A prize is non-taxable when the winner was selected without entering a contest and they donate the prize to charity. Gambling winnings are part of gross income. Gambling winnings should be included in your gross income. Gambling losses can be deducted to the extent of gambling winnings. Gambling losses can be deducted to the extent of gambling winnings. So if you win $500 and you lose $500, you can deduct that full $500 against your winnings, and that would zero everything out. Punitive damages are taxable as ordinary income. Punitive damages taxable as ordinary income. Scholarships and fellowship grants are only excludable if spent on tuition, fees, books, and supplies. Scholarships and fellowship grants do not include room and board, and no services to be performed to receive the scholarship. Scholarship and fellowship grants are only excludable if spent on tuition, fees, books, and supplies. TA's tuition reduction is not taxable if they have other taxable compensation. TA's tuition reduction is not taxable if they have other taxable compensation. Gifts and inheritances are non-taxable for the recipient. Gifts and inheritances are non-taxable for the recipient. Workers' compensation is not taxable for the employee. Workers' comp, non-taxable for the employee. For workers' comp, the employer is strictly liable. The employer purchases insurance from the state or a private carrier. Workers' comp, employer is strictly liable and they purchase insurance from the state or a private carrier. Foreign earned income exclusion can be excluded up to certain income earned abroad if a bona fide residence test at least 1 year and physical presence test they are present in the foreign country. Foreign earned income exclusion can be excluded up to certain income earned abroad if the bona fide residence test at least 1 year or physical presence test present in the foreign country.